From the moment we first receive our allowance or land our first paycheck, money choices begin to shape our future. Yet, a surprisingly large number of people feel they weren't adequately prepared for those decisions. More than 80% of American adults wish they had been required to complete a semester or year-long financial education course in high school. And studies show that nearly 60% of adults believe that personal finance would have been more applicable to their adult lives than many other high school subjects. A recent international survey by the OECD found that in 2023, significant gaps remain even among the most developed countries, with only a minority of adults demonstrating strong financial behavior, knowledge, and attitudes. Observers from The Guardian to the Financial Times have noted that, while some curricula improvements have been made, most students still miss out on essential money skills like budgeting, risk assessment, and credit management. Recognizing and addressing these gaps is the first step toward transforming uncertainty into confidence. Learning to tell every dollar where to go is the fundamental building block of financial health. Yet fewer than half of adults actively track spending categories like dining out, transportation, and subscriptions, leaving critical vulnerabilities in their monthly plans. When asked about their financial goals for 2023, just 42% said they stuck to a budget, despite budgeting being the single most important topic for personal finance education, according to National Endowment for Financial Education Research. Without a clear picture of where income is allocated, many people accidentally prioritize wants, like premium cable packages or frequent rideshare trips, over needs or savings. The reality is that a well-constructed cash flow map is not just a tool, it's a strategy. It empowers you to anticipate bills, catch overspending early, and reallocate funds toward emergencies or investment. Imagine Sarah, a graphic designer earning a steady $4,000 per month. For years, she paid rent, utilities, and the occasional splurge, but never sat down to list her expenses. After tracking every transaction for 1 month, categorizing groceries, transportation, subscriptions, and miscellaneous, she discovered that she was spending $250 on coffee outings alone and $60 on underutilized streaming services. By canceling one service and brewing just 2 fewer coffees per week, she freed up nearly $100 per month. Redirecting that money into her emergency fund not only accelerated her savings by $800 a year, but also gave her the peace of mind to negotiate a rent increase confidently, knowing she could absorb minor cost hikes without stress. Building a savings cushion and investing early harnesses the power of compounding in your favor. While 53% of Americans report having at least 3 months of emergency savings as of 2021, a marked improvement from 35% in 2009, nearly 40% still lack any dedicated emergency fund. A separate U.S. News survey found that 2 in 5 Americans say they have no emergency savings at all. Meanwhile, compound interest can feel like magic. By reinvesting earnings, an investment grows not just on the original deposit, but also on prior gains, creating exponential growth over time. Those who start early, even with modest amounts, see the steepest growth. For example, tucking away $100 per month into a diversified portfolio, averaging 7% annual returns, would yield over $28,000 after 20 years, compared to only $12,000 from contributions alone. Consider John, a college graduate burdened with student loans and no savings. He committed to depositing $200 per month into a high-yield savings account until his emergency fund hit 3 months of expenses, then redirected that same amount into a mix of index funds and retirement accounts. At a conservative 6% annual growth rate, his investments grew to nearly $20,000 in just 10 years, while his savings provided a buffer against car repairs and medical bills. By automating transfers on payday and reviewing his portfolio quarterly, John turned good intentions into concrete results, avoiding high-interest credit and opening the door to compound returns. Credit and debt management is the next critical pillar. Credit scores influence everything from loan rates to rental approvals, yet too many people overlook utilization and repayment strategies. Although the average credit utilization rate hovers around 28% in the US, experts recommend keeping utilization below 30%, and many top performers maintain single-digit usage. data also reveal a wide disparity. While the median cardholder uses about 9% of their limit, the top 25% carry balances exceeding 56% of their credit lines. According to FINRA's foundation, more than 40% of credit card holders in recent studies reported paying only the minimum due each month, allowing interest to accumulate and debt to linger longer than necessary. By prioritizing on time, full payments, and targeting either the smallest balance first for quick wins, the snowball method, or highest interest debt first for cost savings, the avalanche method, individuals can reduce both balances and interest expenses significantly. Mia, a young professional in her mid-20s, found herself rotating debt across 3 cards, each carrying interest rates above 18%. Overwhelmed by confusing statements, she consolidated her balances into a lower-rate personal loan and set up auto-pay for each minimum payment. Then she focused on the highest interest debt with any extra funds, her avalanche approach, eliminating her most expensive loan in 7 months, saving nearly $900 in interest. Soon, she was channeling those monthly savings toward her down payment fund rather than feeding her debt cycle. Shielding your hard-earned progress against life's uncertainties is equally important. Insurance is a risk transfer tool that prevents catastrophes from derailing your financial goals. Nearly 90% of homeowners maintain active home insurance policies, ensuring property losses or liabilities are covered if disaster strikes. And just over 5% of insured homes filed claims in 2021, according to the Insurance Information Institute. Health insurance prevents medical expenses from becoming crushing debt. Auto insurance safeguards against liability and repair costs. And both life and disability policies ensure that dependents remain financially secure if you cannot earn an income. Yet only 18% of U.S. adults report having individual disability insurance, despite 46% acknowledging a need for it, and barely half of Americans hold a life insurance policy. Without adequate coverage, a major illness or injury can quickly exhaust savings and accumulate high-interest debt, reversing years of progress. Picture the Thompson family, 2 working parents with children and a mortgage. They assumed basic employer coverage was enough until a medical emergency left one parent unable to work for 3 months. Out-of-pocket costs and lost wages ate through the family's savings, forcing them to tap high-interest credit cards. After that experience, they reviewed their policies, increased their disability and life insurance limits, and added a small liability umbrella, ensuring that a similar event would no longer threaten their children's college fund. Setting clear, measurable goals is what transforms random saving into purposeful planning. In 2023, half of Americans reported that spending less money was their most common financial goal. 42% aimed to stick to a budget, and 38% sought to build an emergency fund. Goals should follow the SMART framework: specific, measurable, achievable, relevant, and time-bound. Instead of save more, you might resolve to save $5,000 by December of this year by contributing $420 per month, which gives clarity and accountability. Those who articulate these targets are twice as likely to hit them compared to those with vague objectives. Sharing your goals with a friend, mentor, or online community creates positive peer pressure and support, turning solitary aspirations into collaborative accountability. Lifelong learning is the glue that holds financial literacy together. As financial products, tax laws, and economic conditions evolve, so must your knowledge. Since 2020, 30 states have enacted requirements for high school students to complete personal finance courses, reflecting a growing consensus that money skills are as essential as reading and arithmetic. Internationally, campaigns by the OECD, INFE, and organizations like the Financial Times Literacy Initiatives offer workshops and resources to keep learners of all ages engaged. Regularly reading reputable finance blogs, listening to podcasts, and watching expert-led channels, whether it's Finance Academy or others, helps you stay ahead of changes like rising mortgage rates, tax code updates, or new investment vehicles. Ultimately, financial literacy is not a one-time course, but a lifelong journey marked by 5 interlocking keys: budgeting, saving and investing, credit and debt management, insurance and risk mitigation, and goal setting paired with continuous education. Each component reinforces the others, creating a resilient framework that adapts to life's twists, whether a job change, market downturn, or unexpected expense. Today, choose one action you can take. Draft your first cash flow map, automate a $50 transfer to savings, or review your credit report for errors. As you build on these steps, your confidence will grow, and you'll discover that financial freedom is not a distant dream, but an achievable destination. If this guide resonated with you, let's keep the momentum going. Subscribe to Finance Academy, like this video, and ring the bell so you won't miss our deep dives into topics like debt reduction strategies, smart investing, and advanced tax planning. Share your first financial goal in the comments below. Accountability is the secret ingredient that turns good intentions into real results. Here's to your financial journey: informed, intentional, and unstoppable.